Hello, everyone. This is June 10th, 2024. This is your host, Brent Foster of the Northbound Wealth Podcast. Welcome to the show. Thanks for liking and subscribing. Thanks for following us. We'll just keep this thing going. And also, welcome to summer. It's so great to see all the folks out and a lot of activities going on. Kids are out of school in warm weather. All right. Weekly market insights. Solid week despite mixed reports. That's the headline. The Dow Jones Industrial Average inched up 2.29%. Okay, so inched up 0.29%, while the S&P 500 powered ahead by 1.31%. The Nasdaq led, picking up 2.38%. The MSCI EFA index, which tracks developed overseas stock markets, rose 1.29% for the week through Thursday's close. All eyes are on the jobs report. So weak manufacturing data prompted declines early in the week, reflecting investors' concerns over the economy's strength, but stocks rallied in anticipation of the jobs report on Friday. However, the market reaction was mixed when the stronger than expected jobs report finally came. The S&P 500 touched a record intraday high before profit taking late in the session. And on my blog, on my website, which is www.northboundwealth.com, you can check out the Y charts and this article. Y charts basically are the weekly market insights of the major index returns and a summary of those. So the Dow for the year is up 4.09%. The MSCI EFA index is up 8.90%. The Nasdaq is up 14.76%. And the S&P 500 is up 12.91%. And you got a nice chart of the S&P on there. And then also you see the 10-year note in review. The 10-year Treasury note is trading at 4.43%. That's down 89 basis points from the last month. But yet, that's up from the 3.79% print we had about a year ago. All right, the catalyst that wasn't. So the week, last week that is, closed with a jobs report that underscored the economy's resilience while highlighting the data's mixed nature. The 272,000 jobs added in May were higher than the 190,000 that economists expected. At the same time, wages rose 4.1% from a year ago. Strong jobs report and surprise wage increases supported the narrative that the Fed may now wait longer before considering a move on interest rates. Although inflation now exceeds the central bank's 2% target, the jobs report suggests that economic growth remains powerful despite higher short-term rates. So, key economic data that we're tracking. Today, we've got the 3-month Treasury bill auction, monitoring that as we go. Wednesday, Consumer Price Index, the FOMC announcement, and Fed Chair press conference. So, a lot of Fed heads have been talking a lot lately, and it's just crazy, I guess. They're market makers. All right, Thursday, jobless claims, producer price index. Fed official John Williams speaks Friday, consumer sentiment. And let's see, Fed official Austin Goolsbee speaks. That information came from Investors Business Daily, the economic calendar, if you guys were wanting to check that out. All right, notable companies reporting earnings. We've got AVGO, which is Broadcom, on Wednesday, Thursday, Adobe, and then Autodesk as well on Thursday. So not a whole lot going on for notable companies. Those are some of the larger ones I tend to try to touch on. All right. When was the last time you checked your withholding status? Most people check their withholding status at the end of the year or as filing season arrives, but the middle of the year may be just as good a time as any to double check your withholding status and confirm its accuracy. The IRS has a handy tool called the Tax Withholding Estimator, which can help you assess the tax withheld from your wages. The tool can also help you determine if you must complete a new W-4 to submit to your employer, complete a new W-4P, or make additional payments to the IRS. It does this by estimating your annual income, factoring in any children you may have, and earned income tax credit, and accounting for other items that may affect your yearly taxes. Before using the tax withholding estimator, gather all the necessary documents. This includes your W-2 from your employer, your 1099 forms you have from banks and other payers, and any other forms you need. Gathering as much information as possible will be helpful because the estimator will only be as accurate as the information that you enter. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax professional, and this tip was adapted from irs.gov. Now, Before we move on to the next segment, I love strength training and working out and stuff like that, whether you're lifting weights or running or doing HIIT workouts, stuff like that. There are training strategies for every level. So if you'd like to build muscle mass, sometimes the optimal strategies are the simplest ones. For example, becoming proficient in the big four exercises can help you create a literally strong foundation. These four moves include the squat, the deadlift, the bench, and the shoulder press. You can work on some of your body's major muscle groups with these simple movements. Another strategy involves using dumbbells and barbells. While the fancy machines in the gym may appear fun and enticing, mastering the foundational movements with free weights requires building skill. Free weight and body weight training are some of the most effective exercises, and they are also the simplest. Lastly, maintain a log and track your progress. Even doing one or more rep of lifting 5 or more pounds as you progress gets you closer to your goals. These achievements will help you stay motivated and make tracking your progress easier as you get stronger and more in shape, build those muscles and those heart muscles and everything else. This tip was adapted from the Men's Journal. You could apply this type of uh, rigorous type of thinking to your investment portfolio strategies. Are you diversified? Are you overly concentrated? Are you absolutely complacent, not paying attention, doing anything in regards to your investment strategy? So it's probably a good idea to get a plan together, start working out those investment muscles, and having a core foundation. Even though those fancy bells and whistles like cryptocurrency and all kinds of fun stuff out there may be attractive or sparkly or shiny, it doesn't mean that they're what's going to actually build your core strength or your core aspects of your portfolio. So I thought I'd interweave that. Stay tuned for the next segment. We've got a good show for you. Thanks. June is National Cancer Survivors Month, and our hearts are with all who have dealt with the battle against cancer. Cancer is one of life's cruelest trials, but survivors emerge as beacons of resilience. To the survivors, your perseverance is heroic beyond measure. To caregivers, families, and friends, you deserve recognition for shouldering heartbreak, yet carrying your loved ones through with endless love and devotion. Cancer creates an unbreakable bond of compassion between all who understand its harsh realities. We all know too many people who have been victims of this awful disease. Let's celebrate survival while honoring every brave story. We also reaffirm our commitment to supporting medical pioneers and organizations working tirelessly to research treatments and find cures to eliminate this awful disease. Hashtag National Cancer Survivors Day. Stand with us, stand together. Northbound Wealth Management. This segment is on the evolving relationship between stocks and bonds. I posted this out there on the blog. We've got a correlation of the S&P 500 one-year total returns monthly versus the Bloomberg US aggregate one-year total returns monthly. And the valuation on that is 0.857. And what that means, and that date range basically goes from April 30th, 1998 to March 31st, 2024. Here's the reason why I put it out there. Sir John Templeton, he was a famous philanthropic person and investor and manager of money. The four most expensive words in investing are, quote, "This time it's different." And normally we would agree, but the phrase, "this time is different," may apply to what's happened in financial markets in recent years. What's new? For most of the past quarter century, stocks and bonds have moved in opposite directions. This movement created what's called a negative correlation between these two asset classes. But in recent months, the correlation between stocks and bonds hit multi-decade highs. As you can see in the chart above, which I have on my website, courtesy of Y Charts. Thank you, Y Charts. The correlation between the S&P 500 and the Bloomberg US aggregate one-year total return has been quite high. In other words, stocks and bonds are moving in the same direction. not negatively correlated, but they call it positive correlation. That positive correlation is starting to raise questions about the benefits of a diversified portfolio. Remember, diversification is an approach to help manage but not eliminate investment risks. So, what's the cause? The positive correlation began in 2022, but the most recent activity spotlighted the issue. As the Fed started raising interest rates in 2022 to manage inflation, bond prices, which generally move in the opposite direction of bond yields, actually trended lower. At the same time, economic concerns put pressure on stocks, which fell into bear market territory for much of 2022. The result was traditional diversification didn't produce its expected results because stocks and bonds both went down quite a bit. And that was interesting. That was very interesting. One of the best investments in 2022 that you could have made was cash, or selling cash and buying the market when the market was down. So, what's next? The answer to this question may depend on how the economy unfolds over the next few months, which is why the Fed is getting so much attention. Last year, the Fed signaled that its next move would be to lower short term interest rates, but it stopped short of giving a timeline. Stocks and bonds trended together as Wall Street began to think the Fed may have pulled off a quote unquote soft landing, where growth slows, but the economy doesn't tip into recession. However, inflation is still sticky, so the Fed has been unwilling to change its policy as it is waiting for consumer prices to stabilize. But what happens in the event of a hard landing? The ramifications could include job losses, credit tightening, and market volatility. This may create a world where bonds and stocks might move in opposite directions and, voila, produce a negative correlation. But not too many people appear to be cheering for a hard landing. A third possibility is, quote, no landing, end quote, in which the Fed keeps rates at their current levels for a long period of time because inflation remains high. It's unclear how this would affect the correlation between stocks and bonds. Our perspective. There is a school of thought that the recent positive correlation between stocks and bonds is a return to historical norms rather than an anomaly. One longer term study showed that the past 3 decades of negative correlation, where stocks and bonds moved in different directions, should not trump 3 centuries of data showing that these asset classes moved more in sync. The study concluded that although the past 2 years have been rough, diversification should not be discarded as an investment concept. However, it did suggest that the economy appears to have moved past a long period of low inflation, which allowed the Fed to keep interest rates at low levels. So, helping clients. The traditional approach to diversification has relied on the negative correlation between bonds and stocks to help smooth out the investment journey. But in some instances, today's positive correlation may have a bit of the opposite of the effect. When we create a portfolio strategy, we base it on investors' goals, time horizon, risk tolerance. Changes to any one of these factors can cause us to reconsider our original approach. At the same time, we are constantly monitoring the overall investment climate, and we continue to learn so that we can keep bringing new insights to clients. In the back of our minds, we hear Sir John Templeton saying, quote, the 4 most expensive words, end quote. But we never sit still when it comes to learning about money management. So stay tuned for the next segment. So, as many know, Roth IRA contributions are made with after-tax dollars, so your child will only pay taxes and perhaps penalties once they make withdrawals. So here's an idea. Have you opened a Roth IRA for your son or daughter? Anyone have a son or daughter who's starting a summer job? That's called income, making some income, and that's a great way to utilize the tools out there for saving and investing for your child's future. So what you may not realize is how flexible they are. Your child can now withdraw up to the amount of their total contributions at any time for any reason without paying taxes or penalties. However, you may have to pay taxes and penalties on earnings. They can also withdraw contributions before age 59 and a half and before the account is 5 years old for the following. This is important. Keep in mind that you may be able to avoid penalties, but not taxes. Okay, here are some reasons. Funds can be used for qualified higher educational expenses. First-time home purchase up to $10,000 lifetime limit. If your child becomes disabled, for certain emergency expenses. If your child is unemployed, they can use a withdrawal to help pay for health insurance premiums. So here's some things to know. Your child must have earned income to contribute to a Roth IRA. You can open a Roth IRA for your child and manage it until they reach the age of majority in your state. The maximum contribution for 2024 is $7,000 or the total of their earned income, whichever is less. Opening a Roth IRA for your child's summer earnings is a powerful way to teach them about saving, investing, and building long-term wealth. It is never too early to start. Oh, and don't forget, they may need help filling out their W-4. If your child earns less than $14,600 in 2024, they may want to claim an exemption from withholding on their Form W-4 by writing quote unquote exempt on line 4C of the form. With a Roth IRA, remember that to qualify for the tax-free and penalty withdrawal of earnings, Roth IRA distributions must meet a 5-year holding requirement and occur after age 59 and a half. Tax-free and penalty-free withdrawals can also be taken under certain other circumstances, such as the examples in this podcast. The original Roth IRA owner is not required to take minimum annual withdrawals. This podcast information is for informational purposes only and is not a replacement for real-life advice. Consider consulting your tax, legal, and accounting professionals if you have questions about completing the W-4 or whether or not you should invest in a Roth. You can talk to your financial advisor. I hope these summer financial tips are helpful. Let us know if you have any questions, and we're always here. Northbound Wealth Management, 317-399-1107. Stay tuned for the next segment. In this segment, we're going to review the month of May as far as performance in the stock market. So stocks rose in May as investors cheered upbeat Q1 corporate reports and signs that the economy was still strong while not overheating. The Dow Jones Industrial Average gained 2.30%, while the S&P 500 added 4.80%. The tech-heavy NASDAQ picked up 6.88%. So May wrapped up the Q1 company report season. The S&P 500 is on track to post 5.9% growth rate for the quarter, which will be the highest year-over-year earnings growth rate since Q1 of 2022. Mid-month, mega-cap tech names rallied in anticipation of the Q1 corporate report from NVIDIA, which makes semiconductors for artificial intelligence and is one of the largest stocks in the S&P 500 by market cap. NVIDIA's upbeat report helped lift the NASDAQ to a fresh record. NVIDIA's corporate report should not be considered a solicitation for the purchase or sale of the company's stock. Investors see Goldilocks scenario. Gains over the month were also driven by a delicate balance of Goldilocks economic data that were not too cold and not too hot. For example, 175,000 jobs were created, which was a solid number, but less than the 240,000 jobs that economists had expected. In addition, a cooler than expected CPI report released mid-month sparked a broad-based rally as news raised investors' hopes that the Fed might adjust interest rates at some point this year. The news helped push the Dow above 40,000 for the first time. So the sector scorecard, 10 out of the 11 S&P 500 sectors ended in the green, led by utilities, which was up 8.98%. Technology was up 7.08%. And the communication services sector was up 6.94%. Real estate 5.11% to the upside, materials 3.28 to the upside, and financials 3.25% to the upside. Also posted solid gains. Consumer staples 2.45%, healthcare 2.40%, and industrials was up 1.68%, and consumer discretionary was up 0.20%. Rounded out the winners. The only category really that was down was energy. It was down 0.32%. And that's what it ended the month lower in. So the U.S. market recap for May 2024, as seen in my emails that I send out. If you subscribe to the blog, you'll get these emails, and we can go from there. But what investors on the 7th of June talking about May, and so I want to make sure that I address that. Today is the 12th. And I just want to say that I watched the Fed meeting here, and I'll cover this next week. And it looks like they're going to keep interest rates higher, and it looks like the market is probably pricing in, and the Fed is talking about one rate cut between now and the end of the year. And the markets are rallying on that. I'm looking at the S&P 500 at 5421. And that's up quite a bit. The Dow is below 40,000 at 38,712, and the NASDAQ is around 17,608, which is up quite a bit, 1.53% on the day alone. So looks like gold is up. Gold is trading around 23.22 an ounce. Silver is at about 29. Aluminum is trading around 25.75. Platinum's around 962. The VIX is down to about 12. That's down 6% on the day. You're looking at corn trading around 453. Wheat 416 a bushel. Soybeans at 1,177 a bushel. So, gosh, things are kind of in a great spot. Commodity prices: sugar 19, coffee at 224, lumber at 498. So there you go. I just kind of blew through some of those. But Apple is expected to release its latest iPhone software and preview what is coming for the second half of the year. Apple will tease new features of upcoming software releases, and investors are expecting to gain insight into Apple's artificial intelligence strategy. By the way, they did release some of that information this week. The other day, the stock itself was up around 5 or 6%, which is massive considering how big of a weight Apple is in the S&P 500 and the economy as a whole. So it's pretty phenomenal to see that. Let's see here. Apple's corporate event obviously is not a solicitation for the purchase or sale of the company's stock. While AI mentions, artificial intelligence, AI, from S&P 500 companies have steadily increased, Apple hasn't provided many updates, but it did. It says it's going to partner with ChatGPT, so that was the big news. World markets. So the MSCI EFA index, which tracks overseas foreign markets other than the United States, gained 3.29% in May as markets rallied globally. European stocks performed well, with Germany picking up 3.16% and the United Kingdom tracking on a 1.61% basis. Spain led, gaining about 4.31%, while France was flat at 0.10% to the positive. Pacific Rim markets were mixed. Australia rose 0.49%, and China's Hang Seng index rose 1.78%. However, Korea was down 2.06%, and Japan's Nikkei was flat at 0.21% in May. So again, I cover a lot of the global markets on these indices on my blog. Thank you, Yahoo Finance, for this data. So indicators we're tracking: gross domestic product. The second estimate of economic growth for the first quarter was revised downward from 1.6% to 1.3%. That's in the U.S. Employment. Employers added 175,000 jobs in April, with the 303,000 jobs created in March, and less than the 240,000 expected. The unemployment rate ticked up to 3.9%, while average hourly earnings increased 3.9% year over year in April. Both unemployment and wage growth were less than expected. And Jay Powell was talking today about how wages increasing is really a big part of the sticky inflation that they're trying to battle. And he does believe they'll get to a 2% rate target, but not yet. It's going to be higher for longer. Retail sales remained unchanged in April following a revised increase of 0.6% in March. The April figure was below expectations. Industrial production. So industrial output fell 0.3% in April, driven by declines in durable consumer goods, cars and car parts, and electrical equipment and appliances. The April number missed expectations. Housing. Okay, so housing starts rose by 5.7% in April as builders anticipated pent-up demand for buyers on the sidelines. April existing home sales dropped 1.9% from March 2024 as demand exceeded available inventory. April sales were down 1.9% from a year earlier. The median sales price was up 5.7% from a year earlier to $407,600. New home sales fell 4.7% to a seasonally adjusted rate of $634,000 as higher mortgage rates appeared to take a toll on demand. It still continues to. It's pretty much locked up. I mean, we're just not seeing a whole lot of loosening except from the people that really have to move. A lot of folks are just staying put. They're locked into low rates prior to the rate increases, and they have really no motivation to really move. So until rates go back down, we're going to see kind of this higher prices for longer situation. So we'll see. Consumer price index. Consumer prices rose 0.3% in April over the previous month and 3.4% compared with a year prior, both in line with expectations. Core inflation, CPI minus volatile food and energy prices rose 0.29% for April and 3.6% year over year, the lowest increase in 3 years and just below expectations. It was the first time in 3 months that the core CPI was lower than the forecasts. Durable goods orders. Orders of manufactured goods designed to last 3 years or longer rose 0.7% in April compared with a 0.8% increase in March. The April increase exceeded expectations. The Fed, minutes from the Fed for April-May, the FOMC meeting released on May 22nd stated that some Fed officials worried about the lack of progress on inflation. At the meeting, the FOMC kept the Fed funds rate steady at 5.25 to 5.5% target range. The next 2-day FOMC meeting concludes on June 12th. That is today. That's kind of why I waited to release the podcast until today. They're going to keep rates higher, and I'll continue to discuss what the Fed is likely to do or may do in the coming weeks and months. And it's all about the numbers, all about oceans. So get this. This will be kind of a fun fact to wrap it up. 1,220 feet, largest wave on record set on July 9th, 1958 in Alaska. 36,201 feet is the deepest place in the ocean. The Mariana Trench. Can you believe that? 36,201 feet. That's just insane. 70% is the percent of ocean floor the abyssal plains, 10,000 feet below sea level, covers. All right, 33,500 feet. Mauna Kea on the Big Island of Hawaii is the tallest mountain on Earth, 33,500 feet. 13,803 feet is the height of Mauna Kea above sea level. 19,700 feet is how far Mauna Kea descends below sea level, and 40,000 miles, the length of the longest mountain range on Earth, and it's all underwater. 150 feet is the length of the average Siphonosaur, the ocean's longest animal. No kidding. I didn't know that. Wow. 61 feet, length of the biggest shark on Earth, the whale shark. 80 to 130 years, the lifespan of a whale shark. You heard it here. You guys enjoy the rest of the week and the weekends, and I'm going to release the next podcast probably early, middle of next week. Until then, thanks for liking, subscribing, and following the Northbound Wealth Podcast with your host, Brent Foster. Take care and talk to you soon. Welcome to the Northbound Wealth Podcast. All opinions expressed by me, my co-hosts, or my guests are solely our own opinions and do not reflect the opinions of Northbound Wealth Management. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, and tax advice or as a solicitation to offer or buy any securities. Clients of Northbound Wealth Management may maintain positions in the securities discussed in this podcast.